Good morning, everyone. Thank you for joining in today's webinar. I hope you can see my screen and I hope you can hear me clearly. We wanted to have this session today primarily because we've had a big event yesterday in terms of the RBI's announcement. We're also wrapping up the year, and I'm sure there are many questions about how you should look at managing your more conservative investments in this environment. If you're somebody who's looked at renewing an FD or looked at parking fresh money in an FD, I'm sure the returns today have not been very attractive. And there has been a question of where to move these funds. So when we're trying to answer this, let's look at the context of where we are and how we can build a fixed income playbook for a cycle where interest rates are low. This is broadly the context for today's webinar. But going by our regular structure, we'll have some time for presentation and then we'll open up for Q&A towards the end of the session. If you have any questions on your mind, please feel free to put it into the chat box and I will be going through everything that's there at the end of the session. Thank you for joining us. Learning Saturdays has been an initiative that we've been working on over the last few years to bring insights to every investor once a week. We have other sessions happening today as well. So thank you for participating in this, and we hope that you have something that you can take away that will help you create wealth at the end of this session. So why is it that we think today's webinar is contextually relevant? I think when we look at how the RBI has planned this year, you have seen that they very clearly moved into rate cut territory. And keeping this in mind, investors are also seeing the effects of these rate cuts, whether you're looking at how it affects the home loans or any kind of liabilities that you have, or if you're even looking at how your investments are changing. So the kind of return that you're getting from your bank account, the kind of return that you're getting from fixed deposits, whether you're doing a bank FD or a corporate FD, you are seeing a change in the return profile of your investments. The second thing that we wanted to address is the fact that the policy stance has been neutral for a while, despite having the most recent rate cut, which happened yesterday. You're also at a phase where the environment is actually accommodating, right? So you have better liquidity conditions, you have willingness to cut rates, you have low inflation, high growth, which is actually a great combination to keep interest rates low. Because our target growth, of course, is higher than the kind of growth that we have achieved, even though globally we're still doing quite well, right? And the inflation trend also is moderating. So if you see the kind of revisions to the inflation forecast that have happened, the revisions to the growth forecast that have happened, that actually just leaves more room. And from a global standpoint also, you're not seeing the kind of environment where global growth is immediately picking up. It is looking better for 2026, but I think as far as the US economy is concerned, you do have some kind of question mark hanging over how the labor market is, because some Fed participants, of course, are talking about how labor market conditions can quickly deteriorate, and that need not show on your month-on-month numbers either. So all of this actually results in your yields coming down. So if you've been somebody who's already invested in fixed income, then you're probably looking at much better returns. But if you are somebody who's just starting out on fixed income, the forward returns may not be as attractive as the last 1 year returns. So this is an important juncture, right? Because a lot of investors do look at fixed income as an asset class where you get stable returns. So ideally, what you want to see is maybe how this fund has performed recently and whether it can kind of sustain that kind of return for you in the coming year. But all of this being said, I think it's important to recognize that we are at an inflection point, and what we've seen so far need not necessarily be what you're going to experience going forward. So let's first look at our inflation number. And I think where we are today is that you're seeing inflation at the lowest level. It's close to 0%, the October print, it's at 0.25%. And when we look at, say, the your last quarter's inflation number, it's actually below 2%, which is the lower band of the RBI's target. And if we look at what the average level of inflation has been between, say, 2021 till now, the average level of inflation has been close to 5%. So, what has actually contributed to inflation coming down so significantly? When we look at how the CPI is calculated, a large part of the basket is actually food, right? And within food, vegetable prices last year were shot up quite a bit. So when you look at 2024 data, you do see, or 23-24 data, you do see a fairly high base, right, which has contributed to higher levels of inflation in the last year, but the readings were not showing that because 23 levels were higher than 24 levels. So even a slight growth was giving you a much higher inflation that you were experiencing, but may not have shown up statistically. So now what is happening is from the high base, we're actually moderating. Food prices have gone into deflation territory, right? So when you look at inflation, you see it in three parts. So there's one, which is inflation, which is the rise in prices. Then you have deflation, which is a slowdown in the rise in prices. So let's say if prices were rising at 3% last year, but this year they were rising only at 2%, you would call that a deflationary zone. And then you have disinflation, which is when you are going into negative territory, right? So what you're actually seeing is disinflation within the food basket because you had a lot of variation in monsoon and food production in 2024, which disrupted your price basket, which has significantly changed in 2025. So you're seeing much better supply in the market. You're seeing forward conditions also looking more conducive to keeping prices stable or lower. So this is essentially one of the contributing factors for your inflation level to be low. The other thing, of course, has also been that oil prices have been fairly stable this year and below the $75 barrel per mark. In fact, off late, it's been closer to $65 a barrel, right? And despite all of the OPEC production cuts, oil prices have not been rising much in 2025. Now, food and oil are actually like the most volatile components of your inflation basket. So if you've been somebody who's looking at both headline and core inflation, and you've noticed that core inflation is actually not coming down so significantly, but your headline inflation number is, this is probably why, because your core excludes these two volatile items, and that's the explanation behind that. Even accommodating for that, we are at lower levels of inflation, and we are definitely at a point where you're not in the comfort zone for the RBI. While the long-term target is 4%, you have some variation with a plus or minus 2% band, right? So inflation being in the range of 2 to 6% is acceptable, but you don't want it to stay below that, and you definitely don't want it to be at the extreme of either of the bands for a long period of time. All right, so let's quickly recap what have been the rate cut actions in 2025. So when we look at how this year started out, so the RBI had been in neutral territory for a long time. They did not raise interest rates or cut interest rates last year, and they started out with cutting interest rates this year, right? So you had a governor change in December 2024, and then you had your first rate cut come in February. That also then you had your next rate cut come in April, and you had a mega rate cut in June. So you had three consecutive meetings where the RBI cut rates. The idea was they wanted to front load the interest rate cuts. Broadly, this means that they acknowledge that when you cut interest rates, you don't see the transmission of those rates into the economy immediately. So you need to act a little bit ahead in time to ensure that when the economy needs liquidity support and when the economy needs lower cost of borrowing, it's available at that point. So these are preemptive rate cuts that kicked in. Now, beyond this, you also had the RBI make additional liquidity announcements to ensure that liquidity kind of stayed available within the system through an extended period of time. So this is in the form of the CRR cuts also, which they announced, which they said will happen between September and December. Now, this is also a time, so December again being like an advanced tax deadline is a space where you tend to see a liquidity crunch. And this is essentially something to combat this, which was done well in advance. Now, beyond this, what happened in August and October is you continue to get lower inflation readings, but the RBI decided that they wanted to keep interest rates as they are. They wanted to maintain the stance as they are because broadly the logic is when you're in a neutral stance, you're not actually saying that you won't cut interest rates. You're not actually saying that you will hike interest rates either, right? But a lot of people thought that the stance shift which happened in June after the mega rate cut of 0.5% indicated that the RBI was done cutting rates for this year, right? Because they made the 0.5% cut, they introduced the CRR measures, and then they quickly shifted the stance from accommodative to neutral. And of course, in recent weeks, the headlines have all been about how, you're having a lot of rupee instability, the rupee is depreciating against the dollar, so lowering interest rates and the Fed sounding a little bit more hawkish did not really create the perfect environment. Especially when the growth numbers came out, the clear-cut case for a rate cut became more clouded, right? Because when you have high growth and you have so much uncertainty, do you want to keep your powder dry or do you want to cut interest rates? That's a key question that you have. Now, I think what was clear is like even prior to the December meeting, the governor did clarify that rupee is not something that they would like to interfere in, and this would be more of a free float market. I mean, driven by market forces rather than trying to peg the rupee at some kind of specific level, because in the past, whenever any central bank has tried to defend their currency at a specific level, you've tended to see a lot of vigilante actions which drain the central bank reserves. So allowing the rupee to float according to market conditions makes a lot more sense. Moreover, in every policy meeting, if we go back and look at the minutes that were shared, what you would notice as a common thread is that the committee members did not think that holding interest rates was an easy decision. It was after a lot of deliberation and the fact that there were other priorities at each given point in time that led them to hold interest rates where they were. But there were enough compelling reasons to actually reduce interest rates. So we can say that the committee, in terms of interest rate trajectory, has been dovish through this entire period of 2025. It's just that when there was higher uncertainty globally, when you had a lot of trade friction, you did not want to be early or too early in the rate cut cycle and have very limited options towards the end as things evolve. So that moving from wait and watch has clearly happened. And we are expecting, I think, this Fed policy to also be interesting because there's been a divergence of views within the Fed. And of course, the direction that the Fed takes, while it doesn't determine what the RBI does, gives you a sense of what the options the RBI has are. Right. So this recent rate cut has been again another measure to keep liquidity conditions better, to help in terms of transmission and to support growth, because the uncertainty is reduced, but it's still above average or above the normal comfort level that the RBI would like to deal with. So if we look at how liquidity conditions have evolved through the year, what we're seeing is an improvement in liquidity, right? So last year when we started out, we were in deficit, and this year we're actually well in surplus. And in addition to the rate cut yesterday, you had two other liquidity announcements. One was, of course, your OMO purchases, and this essentially means that this is a way for the RBI to inject liquidity into the market, right? And how this happens is the RBI buys bonds, so they're exchanging INR for bonds. So assets are coming into the RBI balance sheet and cash is going into the system. So this is one mechanism in which they have increased liquidity. The second is the USD INR buy sell swap. So what the RBI does is that they buy USD from Indian banks, which is like a spot transaction, and that increases rupee liquidity in the banking system. And what at the end of 3 years, because that's the tenure that they've announced, what will happen is they will sell back the same amount of USD to at a higher price, right? So there's a premium for holding the dollars for a certain number of years to banks at a pre-agreed date. So this is something that is part of the broader liquidity operations, and it's not something that is like a core liquidity announcement. And this essentially gives you two ways in which you're bringing rupee liquidity within the system. So what have been the rate cut drivers? So one, of course, you are seeing an economic slowdown, and this has been consistent. So if we're looking at, I think services has picked up recently, but manufacturing has still not. You are seeing lower spending from corporates, and there are some early signs that corporate or private capex is increasing, but until you see a visible trend and a durable trend, you can't really call it, right? Beyond that, you're seeing inflation be very low compared to what comfort levels are. Globally, you're seeing rate cuts occur. Borrowing costs, despite the rate cuts, are still a little bit elevated. So you've not had full transmission of existing rate cuts. So another rate cut would help in terms of pushing through the transmission of existing rate cuts at least. And the economy needs some level of growth support here. So keeping all of this in mind, there have been enough drivers for rate cuts. The only thing maybe holding the RBI back would have been rupee valuation to a certain extent and uncertainty to a certain extent. And we can see that for maybe a quarter or so, or 2 quarters, you are seeing a fair amount of restraint from the RBI side in playing this wait and watch mode before they made their next rate cut move. So now let's talk about this quick relationship that exists in markets between interest rates and bond prices, right? It's a fairly simple structure. When your interest rate goes up, your bond prices come down. When your interest rate goes down, your bond prices go up. So it's an inverse relationship. And this essentially we can illustrate very quickly is, let's say you have a 1% rate cut that happens in the economy. So before the rate cut, you have higher interest rates and you buy a bond for 100 rupees and it pays you like an 8% interest, right? Now, after the rate cut, if the same borrower comes to the market, they're not going to be borrowing at 8%, they are going to be borrowing at a lower return or a lower rate of 7%. So the new bonds in the market issued by the same issuer have a lower interest payment, right? But ideally, these two bonds are identical in terms of risk, right? It's the same issuer, it's the same timeline. You're just looking at pre-rate cut and post-rate cut. So somewhere the returns for both types of investors have to equalize. And this equalizing happens through a mechanism where prices adjust, right? So one way for prices to adjust would be that obviously every investor would prefer to earn an 8% interest over a 7% interest. So the demand for the older bond goes up, and when the demand for something goes up, the price also increases. Or the other way for the price to adjust is that you expect that the demand for the 7% bond would be weak, and because the demand there is weak, you see the price of the 7% bond drop, right? So people are willing to pay less for the new bond and more for the old bond. And this is why you're seeing this change in this inverse relationship between your two bonds. So your old bond becomes more valuable. And if, let's say, the duration is about 5 to 7 years, then roughly your price increase would be 5 to 7%, or you would see the price go up by 5 to 7 rupees on 100 rupee face value. So this is like a simple way for you to think about how interest rates affect bond prices. Now, in this case, you're assuming 100% transmission, etc., etc. But the real world is a lot more messy, and you don't see such a linear transmission in rates. There can be other factors that also influence the way prices move. So let's talk about a situation in which bonds actually rally the most. So the beginning of a rate cut cycle is a positive signal for bond rallies. But rallying really happens when there is ample liquidity, right? If there's no liquidity, then what tends to happen is your supply demand equations are completely skewed, and that essentially translates into less money being available to chase bonds, which means you're probably not going to see any change in price levels. You also need stable macros. If an investor is worried about where inflation is going despite the rate cuts, they're not really going to be willing to pay more for bonds, because you want that real return to also be decent, right? If you're looking at non-government bonds, you do see a rally when there are credit upgrades, right? So if a company has been able to manage its balance sheet better, if it's able to generate more cash flows, if it's able to retire debt and it's moving into healthier balance sheet territory, or its business is growing at a much faster pace, then you have the potential for a rating upgrade, and that can also push bond prices up. And what bonds are affected the most by rate cuts? I think this is broadly what would react most to a rate cut, right? So you need government bonds because rate cut transmissions are direct to the government security market. It continues to trickle down into, say, banking bonds, PSU bonds, and maybe even AAA rated corporates. But beyond that, you don't really see rate cuts affecting bond yields, right? As you move down the credit curve, the rating upgrades are what can push prices up more than interest rate changes. So bonds with a longer duration expect a higher impact than bonds with a shorter duration, right? And just to reiterate in that example, when we said that, okay, if the duration is 5 years, then you make 5%. If the duration is 7 years, you make 7%. So that's what we mean. Like, as you take a higher duration, and duration does not necessarily mean the same thing as maturity, right? Duration is a bond metric, which is based on the time at which cash flows are received. So a 5-year bond does not necessarily have a 5-year duration, just to keep that in mind. All right. So who wins in a falling interest rate environment? You tend to have a gilt funds, which are basically government bond funds where you're taking a duration call. So these fall the most, these have the highest price rises when you see transmission come through and liquidity conditions support. Then, of course, long duration funds typically tend to also hold long duration government bonds, and these are sensitive to high to interest rate changes. And this works both ways, right? So when you're in a rate hike cycle also, you would see that these categories tend to take the biggest hit in terms of returns as well. Dynamic bond funds, depending on where the duration is, can also respond fairly well to a falling interest rate cycle. And the advantage of being in a dynamic bond fund is that the duration can adjust to whatever is happening within the market, and you don't have to change from one category of funds to another category of funds, as long as the fund manager has a proven track record in terms of having a strong model that helps them adjust their duration according to the market cycle. So, what tends to be stable in these kind of environments? I think your corporate bond funds tend to be a little bit more stable. You don't see too much in terms of price gains unless there is like re-rating, and this tends to be the higher quality side. So you tend to see a more stable return profile. Banking and PSU funds again are can see some change in yields because of their nature of being higher quality debt. So you will see less volatility. You might see some upside in this category as well. So what should you avoid in this environment? Right. So if you're looking at liquid and ultra short funds, as so whenever you have a rate cut, the first segment of the yield curve to react, both on government as well as corporate, would be your money market segment, right? So your 1 year money is the one that's 1 year or less money is the one that's going to react fastest. So this shows up in how your savings bank returns change, your FD returns change. So when you're looking at liquid, ultra short money market, that kind of money, your returns are going to come down quickly, right? So if you have short-term needs, right? So if you're parking money to pay for school fees, if you're parking money because you want to reinvest in the markets, if you're parking money for any like a vacation or any short-term goal, then the return number should really not bother you, because what you want is safety of capital, right? And this is why you shouldn't like lose sleep over trying to get that extra 0.5% or that extra 1% return, because it's just not worth the risk or the trouble that you're taking. So when should you avoid this? If you're expecting this category to create a lot of wealth for you, that is going to be a tall ask, right? So if you're expecting high returns from this, liquid and ultra short are not going to be able to give you that kind of return as transmission and rate cuts go through. You also need to look at credit risk as a category only when the cycle is appropriate, right? So you need to have a decent level of growth. You need to have potential for re-rating in the credit segment. You also need to have credit growth coming into the economy. And you need to avoid this when there's economic uncertainty. Lastly, when it comes to floaters, these are derivative products. And I think normally what people like the simplified version of what a floater fund is that they tell you that when interest rates rise, you get a better repricing because you're getting a floating return. And when interest rates come down, you're getting lower returns because as the rates come down, the interest that you earn will keep reducing. But in the Indian bond market context, you don't have that many natural floater bonds, right? There aren't that many floating rate instruments that have been issued. So what happens is floaters are created synthetically through derivative contracts, and these derivative contracts have a spread. That is basically like the difference between what you pay and what you earn, right? So when the spread is attractive, meaning if you are able to earn more than what you're paying, and there is like obviously a level of uncertainty because both counterparties do think that they're entering into a contract that works for them. So when you have reasonable spreads and visibility, that's when floaters work. And if you have no spreads, then you're assuming a certain level of risk, which may not translate into returns. So that is essentially what you want to look at. Of course, the derivative contract itself is a little bit more nuanced, but I'm not going to get into that. Broadly, this is a category where you need some level of expertise to understand when to invest and when not to invest, or some communication from the fund itself for you to be able to judge that. Okay, so now let's quickly look at the difference between, say, an FD and a debt or a hybrid fund. So, if you're looking at an FD, your returns are going to be in the 6 to 7% range, maybe even lower depending on the quality that you're taking of an FD, right? So, higher quality FDs are going to pay less in this environment, and lower quality FDs will pay more. But even when we look at AAA corporate FDs, I think you are going to see sub 7% on a 1 year basis. Maybe beyond 2 or 3 years, you might be touching that 7% number. When it comes to debt funds, you can expect maybe a little bit more or an equivalent pre-tax return. And this will be market linked as well. So it's not going to be linear like your FD where every year you get paid the same interest. This is going to be market linked. So your returns can actually vary a fair amount. And hybrid funds may have some allocation to arbitrage and equity, and that can actually take your return even higher to maybe say 8 or 9%, depending on how the fund is structured, right? So when it comes to risk, of course, your FD is going to rank number one in terms of risk management. Your risk is very low. Specifically, if you have a bank FD, the risk levels start to increase if you move from, say, like a bank to a small finance bank or an NBFC or a corporate FD, right? And when it comes to debt mutual funds, uh, you need to look at the credit quality. So typically, the mutual fund universe does not operate in very high risk credit. So your risk will tend to be lower, but depending on, say, even the duration of the fund, you can see more volatility and variation in returns. So let's also look at the metric of liquidity. Your FD, of course, is you can withdraw your FD early, but whenever you do this, you tend to lose some of the interest that you earned. There is a penalty to take it out. When it comes to debt or hybrid funds, depending on the category, I think in certain hybrid categories, there is a limited or no exit load, but in most debt funds there is no exit load, right? So you can very easily have this money within into your bank account in 1 or 2 working days. So moving on to the taxation, in an FD, whether you're doing an FD where the interest compounds or an FD where you're taking out the interest every year, you pay tax on the notional interest earned, right? So you're always going to lose some money to the interest that you're earning from your fixed deposits. At the same time, when you're working with a debt or a hybrid mutual fund, you only pay tax at the time of redemption for the amount that you withdraw. And in that amount, whatever is capital gains is what you're going to pay tax on, right? So let's say you have 100 rupees that's there in a debt fund, and that grows to 107 rupees, and then you take out or let's say it grows to 110 rupees and you take out 11 rupees from that, then the tax that you owe is actually just 1 rupee, right? It's not the full 11 rupees that you have to pay tax on. So this is how it becomes more tax efficient. And this is why it's a great option for, say, a retired person to look at an SWP from a mutual fund rather than having an FD that pays interest where they're going to be taxed on it continuously. So more importantly, I think for FDs, you don't have too much flexibility in terms of how long you invest because it is a standard list that the issuer is going to give you. So they'll give you maturities at 12 months, 24 months, or whatever dates they have. There might be some special rates for in between periods. But in debt and hybrid mutual funds, the recommended investment horizon may be 1 to 2 years for tax efficiency. But you have the flexibility to redeem these funds at any point that you want. You can lengthen your horizon also. It's not that there is a fixed maturity date in which you'll have to repay or reinvest these proceeds. So, for someone with a longer term orientation, wanting more flexibility and slightly better tax efficiency, I think this category definitely makes sense over a fixed deposit. So let's kind of close with the playbook, right? So you can extend your duration strategically at this point because some longer term bond exposure can give you that benefit. This needs to be done with a clear study of the market because you want to see how bond prices have already reacted to certain announcements before making that decision. Because if you take duration at the wrong time of the cycle, you can end up making losses rather than returns. You also want to keep your credit quality high. We are still in an uncertain environment. So you would prefer companies and institutions with very strong financial health. I think credit as a market has grown significantly in the recent past. You're specifically seeing a lot of investors move towards AIF kind of structures where they're getting high yields, or you're seeing a lot of retail investors participate in the bond market where they're buying bonds that are paying 12-15% kind of interest, right? You want to also look at laddering, meaning if you want to manage timing, volatility, liquidity needs, you can participate in different segments of the yield curve to get you a better look. You should consider hybrids into your portfolio because it gives you the best of both worlds. And lastly, whatever you're doing, a quarterly review is going to help you move forward in a much better manner. So with this, I'm gonna move into what we do at Finesse and what we do at Milestones to Wealth. So Finesse is our initiative where we talk a lot about fixed income, and Milestones to Wealth is a program where we help investors go from wherever they are to their first crore in savings. The idea is to help every investor think bigger. And if you're past the 1 crore milestone, then we help you work towards larger goals like the $1 million milestone. So what does the M2W program promise to do for every investor? We promise to handhold you through this journey to 1 crore. We will guide you in terms of we will guide you in terms of products, how to sort of respond to market opportunities. We will identify and help you scale up at the right time. Learning Saturdays is one of our key initiatives where we are dedicated to teaching you more about markets, investor behavior, investment opportunities. And I think this journey to 1 crore is not just about the money. There is a lot of coaching and mentoring that happens in this journey because you need to cultivate the right mindset. You need to be able to navigate all the emotions that the market throws at you. So this is a great value addition that we are able to bring to every investor who is working towards this goal. And lastly, we help you measure what you're doing. So to know how you're investing, how you're participating in opportunities, how you're responding to certain things, how your portfolio is performing. So measurement is a big part because if we don't measure, we really don't know how far we've come, right? So keeping all of this in mind, what is the outcome for someone like you? You end up having much more financial discipline because the program guides and mentors you into setting the right priorities. You end up cultivating a growth mindset, which means that whatever challenges the market or life throws your way, you're able to find a way to come out stronger. You build investment conviction. So when you're participating in an idea, you're able to understand why that idea works for you. You're able to understand how this is going to help you in the long run. So you expand your decision time frame from just say 1 or 2 months to thinking in terms of years, right? Like what you want to achieve in the next few years, how you can get to your next big milestone. And that conviction is what is going to carry you through. We also create wealth maps for investors, which help them identify their top priority financial goals and help them provide for these goals, as well as get the overall foundation for their financial health in place. And lastly, I think you will be able to unlock scalability. Scalability essentially means that as you grow in your career and profession, you are also contributing to your wealth creation growth. And as you start thinking bigger, you start achieving much higher scale, right? And this is one of the things that you can't build overnight. It takes time, and this is a long term journey, right? For somebody who's starting out with a monthly saving of 10,000 rupees, we can very realistically achieve uh, a 1 crore timeline in maybe 13 to 15, 12 to 15 years, right? And if you want to do more, it's very easy for you to make that happen much faster for yourself. So taking you from wherever you are to your first crore, that is the goal of M2W. And just a little bit about Finesse, we publish a monthly outlook, which you can always read. In fact, in our outlook this month, we had talked about how we expect or how we've seen the narrative change from whether the RBI will cut rates to how when the RBI will cut rates, right? So that is one thing. We conduct monthly webinars. We help in M2W investors with product selection, investment reviews, and portfolio construction as well. Thank you all for joining us today and participating with so much enthusiasm. If you are interested in the work that we do at Milestones2Wealth, please do get in touch with us. We would love to work with investors like you. And you can reach us at 93848 or you can also write to us at info@milestones2wealth.com. And I look forward to seeing you in our next Learning Saturday initiative. Thank you, sir. Have a great weekend.